Guys. Good afternoon, good morning, good evening, depending on where y'all are at. Happy Monday. I hope you guys had a safe and wonderful weekend. Certainly was a lot of fun with the class this weekend for those of you who were able to attend. So let's get going here. We'll talk about SPX. We'll talk about a game plan for the week. Of course, if you have any questions, I am more than happy to answer them. Hey, Lorna, Mirza, great to see y'all. And we'll go ahead with this Monday market update. So starting with SPX, let's actually start with the intraday charts here. Overall, we had a nice bounce to the upside from the close on Friday. Uh, Went up a little bit higher, but couldn't quite reach the 4,600 level. We also have the ATR trailing stop just a little bit shy of that at 45.9978, acting as a technical price resistance. And of course, right, 4,600 is a big psychological level as well. So we might be able to go back up and test that. Certainly, the intraday charts, I would say, are holding on really well today. Notice how even on our smaller time frames, we're still stacked up in a bullish sentiment. Notice how we're maintaining our support levels here on the hourly chart. We're still stacked up in a bullish sentiment. Momentum remains above the zero line currently with green bars, so that's overall bullish with room to move higher. Still more consolidating signals on our lower time frames for the compound breakout tool. So, and it makes sense, right? We are seeing some chop here, even though the bulls are trying to hang on. But on the hourly chart, we still have a bullish signal in the compound breakout tool and a low compression squeeze. So if this can continue to maintain support, if we don't give up those support levels, I think there's a good chance we'll at the very least go back up and test 4,600 today. If not, maybe break to the upside. And as for targets to the upside, you might be asking, well, we're going into a bullish trend. What levels would we play into? And of course, we would consider 46.25, or at least I would, because that's going to be a mini psychological level, for the indexes. But the other level to consider here, of course, from a technical standpoint, would be the highs that we had back here in March, and that's gonna be around 46.37, was the high that we had in March before we saw the pullback. So if we can break 4,600 and continue to trend higher, 46.25 would be that first level, followed by 46.37, and certainly depending on how we act there, if we can continue with this bullish strength, right, and start to break that, that is a really good sign for the bulls and that we're trying to maintain this overall bullish trend that we're in. From a daily perspective, we can see momentum still has room to the upside, but it's been pulling back some with red bars here currently. Now, that can be a sign of slight consolidation. That can also be a sign of exhaustion. But currently, the fact of the matter is SPX has done a really good job of overall maintaining this 10 period simple on the daily chart. We've had a few times where it's attempted to break, but it's usually been very short lived. And then we continue to bounce. On top of that, notice the Bollinger Bands for today. The Bollinger Bands are definitely flaring back open to the upside. So that's a good sign as of right now that they're anticipating a continuation higher and they're making room for it. If the Bollinger Bands remained flat, right, and the price was putting this pressure on it, then it would give us more of an idea that they're not anticipating that break higher, that we should be mindful of a continuation of bullish strength, kind of like what we saw back here in May, and that we could find ourselves going back into consolidation. But right now, they're still flaring open. We're still holding the 10 period simple. So to me, for myself, that means I still overall want to stay bullish in my account until it proves otherwise. Now, that doesn't mean you can't have a hedge out there. For those of you who don't know what hedges are, the way I look at it is it's basically like car insurance, right? The idea is you don't want to pay very much on it. You want to set yourself up with a really good risk versus reward scenario. And it's obviously in this case, the hedge would be to the put side. So that way, if the market does all of a sudden start to sell off, right, because of exhaustion and things like that, we get a stronger pullback, then the hedge can, with that profit potential, can help offset your bullish trade ideas. Ideally, it completely covers everything and still keeps you net ahead. But on the flip side, right? You don't really want necessarily the hedge to work out, which is why you do such a small amount of risk. That way, if everything about the bullish trend like we're looking at continues higher, the majority of your bullish trades ideally work out and they basically help pay for that hedge, right? So that's why I mean like it's kind of like car insurance. You pay for it each month, but you don't necessarily want to use it, right? But the one time you have to use it, it helps cover the rest of the account. So I wouldn't say there's anything wrong with considering a hedge, but like I said, keep the risk smaller, make it a good risk versus reward scenario, and then ultimately still continue to play the trend until it proves otherwise here. Hey, SK59, good to see ya. Hope you're doing well. And Mark, yeah, so for those of you who are in the, elite or annual package from the class, certainly feel free to go check out Cody, in the boot camp training room, so that you guys can get caught up there. Otherwise, you're stuck with me for the Monday market update for the next, roughly 30 minutes, give or take a little bit. And we'll go from there. So that's what I'm seeing with SPX. Now, as a game plan for the week, what do we have coming out? Well, we've already dealt with the Fed, and last week Powell mentioned once again that everything was going to be data related. Now, I find that to be a bit interesting because, of course, the recent reports seem to be showing that things aren't going so bad, right? That inflation is decreasing some, but they still went ahead and did the 0.25 rate hike, which was kind of already priced in at that point. We kind of understood that was a possibility. Um, but the question, of course, continues on if we do continue to get positive news, how positive basically does it need to be in order for them to not do another rate hike? Because they're certainly not looking at cuts. The During the interview and during the Q&A session that he gave, it seemed like the majority of the feds were not looking at cuts until earliest next year. And if y'all recall, if you've been following along with me, right, we talked about earlier in the year how the Fed futures had potentially priced in a cut earlier, for at some point this year, probably in about late fall going into winter time. They were anticipating there to be a cut. And now that's kind of off the table. They've made it pretty clear that, "Look, guys, we're not anticipating any sort of rate cuts this year. If anything, we might do some more hikes or we might take another pause." But of course, they love to go back and say it's all going to be driven on data. The question, of course, we have on the retail side of trading is what does this data have to look like in order to get a cut or not, right? And is, the data really valid? One of the things that comes out and helps inflation along the side of energy and oil prices and gas prices and things like that. Well, I don't know about y'all, but certainly here in Texas, the guys gas prices at the pump when I went the other day were certainly much higher than what we had earlier this year. So it will be interesting to see if that's reflected, if that's taken into consideration going forward. And of course, if they do continue to do rate hikes, especially if it's anything larger than the 0.25, is that going to signal potentially a stronger pullback or at the very least a pause in this market? From the technical point of view, when we go to the weekly chart here, we are starting to get to the top of the axis for momentum, right? Which is a sign that we could be starting to see exhaustion. Now, the reason why I'm taking this a little bit more as a grain of salt right now is one, we haven't yet broken below the daily 10 period simple. So as long as we can maintain that, that's, still a nice bullish trend that we're in currently. Two, the compound breakout tool in the weekly chart is still very much bullish. We haven't canceled out of this yet. That's been printing back here since late March. So if you jumped in late March of this year to get bullish, well done. You had the true low signal helping you out. You had the bullish signal in the compound breakout tool. You had momentum building up. You had the squeeze. All of that would have been a good clue to get long in the market at that point. The other reason why I'm a little cautious about this exhaustion level is because when the indexes in particular, and sometimes you'll see it on individual symbols, but you especially see it on the indexes like SPX, NDX, where when they get to the top of this range, sometimes how they end up acting is they'll get little mini pullbacks, right? Maybe a week where it pulls up. off of exhaustion. In turn, the underlying price will either get a slight pullback down into its support level, like the 10 on the weekly, or it will consolidate. Because remember, when momentum reaches exhaustion levels, whether it's bullish or bearish exhaustion, it doesn't necessarily need a strong reversal in the price. All it technically needs is consolidation. Consolidation can allow momentum to reset. So, what happens when you really start to get into strong bullish runs again, if that's what we're, looking at here for the market, is it will basically happen and act like it did back here in 2020 going into 2021, where we reach the top of the axis, we get a few bars of a pullback. You either get a pullback or you get consolidation, right? But then ultimately, the trend continues and we bounce higher. And so what happens with the momentum bars? Well, they pull back a little bit and then they retest the top of the axis. And then they pull back a little bit, they retest the top of the axis, and they pull back, retest the top. And so when that happens and they're not getting a full pullback to the zero line, well, usually that helps the trend continue to go. And so even though we're at the top of the axis right now, because we haven't broken below the 10 period simple on the daily chart, and because of how, this narrative has worked certainly plenty of times in the past on bullish trends, we could be setting ourselves up for a similar situation where even if we start to get a red bar here, we'll want to be mindful of how support reacts and whether or not a pullback into support holds, or more importantly, and I'd say better for the bulls, is if we just consolidate into support. If we consolidate into support and then it holds, that's a good potential reentry point to play back in the trend. And part of the reason I think this is because on a longer time frame like the monthly, notice where momentum's at. It's way down here, right? Meaning that there is plenty of room to try and continue this bullish push to the upside. Well, what else do we have that's in agreement with it? Well, we've had back here in April a bullish signal on the compound breakout tool that's remained valid. The last time we had a strong bullish signal like this on the compound breakout tool was July of 2020, and we can see what happened there, right? It went higher going into the end of that year and then all throughout 2021. We also have a squeeze, a low compression squeeze, which for those of you who don't know what this indicator, right, that builds up energy. And so if the squeeze starts to fire to the upside, very much like it did last time, that is good for an overall bullish trend view. On the top chart here, we are still technically in consolidation with our moving averages. The 10 period simple, which is this short dash line, is still technically below the 30, but you can see it's starting to roll up. And so once that 10, if we continue with the strength, crosses above the 30, that will go back into a bullish trend formation, right? And as you can see, of course, from consolidation of the moving averages when it goes back into a bullish trend, usually can lead to a longer bull run to the upside that could last on the monthly chart, certainly a couple years. The only thing I am not a fan of right now on this monthly chart are the Bollinger Bands themselves, and that could change. But right now, the Bollinger Bands, they are still pretty flat. And so that's the only slight caution I have about what's going to happen here. And of course, the catalyst could be something like the Fed news or, maybe something bigger world event wise that we're not, being privy to as of yet. But the Bollinger Bands are still flat. So as of right now, they're really not anticipating too much of a break higher. Now, if the underlying price can put enough pressure on the Bollinger Bands, kind of like what they did back here, the Bollinger Bands will start to flare open. And that continues with the viewpoint of, okay, this does look good to the upside. Let's keep going with the longer term bullish trend. If that happens, the next big targets to the upside, I would say, are the all time highs that we've had back here around 4,800. And then if we can break above that, you're going to have 5,000 as a very big psychological level. Notice all the zeros, right, that follow that five. So that would definitely be a big target to the upside for not only us as retail traders, but the big boys, right? The hedge funds, things like that. And then following that is actually 5136, which is the ATR trailing stop. And if we do, and guys, this is of course a monthly time frame, so this could be into next year when this happens. But if we do, or really should say when, because market's overall a bullish beast. So at some point, we'll likely break above the ATR trailing stop. And when that happens, that can create a really strong bullish trend signal. When you get that on like a weekly time frame or on a monthly time frame, it is usually good for a bull trend to the upside for at least a year, if not bigger term. So let's go back and look. Back here, we had the ATR trailing stop printing resistance. That's that red dotted line. It switched, and then what happened? Well, we ran higher, right? We ran into new all-time highs at that point before dropping off last year. Back here, we had the ATR trailing stop switch from resistance to support. Now you had to sit through some chop that year, but overall, what was the bigger picture point of view? Well, that trend lasted from what, 2011 going all the way into basically 2020 when the COVID situation happened and we broke that level. So if you had bought shares on SPY, for example, where you don't have to worry about theta decay and you're just playing the long game of the market itself, that was a beautiful entry point to hold it for like the next 9 years. Back here, we had a switch from resistance to support. Now, obviously, not as dramatic of a move as we've seen recently, but you can see still a bullish run, for the next several years to the upside until once again we started to get that stronger pullback. And then, of course, the switch from support to resistance was right around the housing crisis when that occurred to the downside. So if we can manage to break and turn this back into support longer term, good place that if you haven't already considered buying in shares longer term, right? Or you're just looking to maybe do a bit more of a longer term investment in your account, things like shares on the SPY, or, certainly we could look at the Qs of a similar story and then play that longer term to the upside. And of course, there are strategies you can do around that, like covered calls. That you can take weekly profits on while still keeping the longer term investment of the shares themselves. There's a lot of different ways to play that. But that, of course, would be something to keep an eye on for a bigger picture point of view. So the monthly chart is why I think the weekly chart could act the way it has in the past, because on the monthly chart, there is just so much room left on momentum. And because of that, and because of where the new top of the axis is due to this push that we had in 2021, it has a lot of range to really keep that to the upside. And then when you pair that with the energy behind the squeeze, right? That energy, if the squeeze fires to the upside, can really keep things going. Well, that is like a bull's dream to have that situated. So that's kind of the bigger picture point of view I have right now. We'll see if we can manage to break it. If the Bollinger Bands really remain flat and the price is putting pressure on it, then we might get another downturn and be in chop a bit longer. But so far, this monthly chart is really trying to set itself up for a bullish run again. Now let's go back to what the game plan is for this week. So this week we do have some jobless claims report, right? We have non-farm payroll, so that could affect the market some depending on how that data comes out and what the market's emotional reaction to it is. Because of course, once again, with the Fed saying that everything is data driven, people, right, in general, I say the market, will be looking at those reports a little bit more closely to try and get a clue of whether or not they're going to do another rate hike or a pause going into the next meeting. But then, of course, I'd say the bigger thing outside of that is we have earnings like Apple, right? Amazon, QCOM, BABA, some of the bigger, once again, certainly Apple, right? The bigger components of the market, we kinda have left for this week. We've already gotten through things like Google, Netflix, Meta. We've gotten through those. The last few big names are this week, and so the question, of course, is how are they going to react on earnings? Now, going into the announcement, Apple seems to be holding up pretty well today. It continues to hold the 10. We're actually getting some bullish signals on our lower indicators. We have a squeeze setting up. Now, I don't know if this squeeze would necessarily fire prior to the announcement. Last time we saw a squeeze built up, it didn't actually fire until the day of the announcement, right? Until that following market day. We had the gap up. That's where it started to fire. Trend is consolidated for a bit, but ultimately, of course, the trend was bullish to the upside. From a momentum standpoint, there's certainly room for Apple to continue higher on a daily chart. The caution I have about these is one, we've seen some of the bigger names like Netflix, for example, where they technically hit the numbers that they were looking for, but they ultimately dropped right off the news. The market reaction was like, this wasn't as good as we thought it was going to be. It was kind of already priced in. And so we dropped off of that earnings announcement. So the question is that going to happen to Apple? And one of the clues that might happen that we need to be a little bit mindful of is once again exhaustion levels. Notice that Apple's right at the top of the axis and we're actually attempting to get a red bar this week. Now that might flip if Apple really gets a strong gap and push higher, but sign of caution here that we could start to either see some chop or maybe a little bit more of a pullback if Apple needs to reset on the weekly chart. And then, Randy, great question. So for my chart settings, I personally am using Thinkorswim right now for my charts. And some of these indicators you can find on the Simpler Trading website because they are proprietary. But outside of that, a lot of the indicators I use are free indicators. So the Bollinger Bands, for example, the second and third deviation Bollinger Bands here, my moving averages, the Awesome Oscillator is a free indicator. I have technically the Squeeze Pro on my chart, but if you do have a Thinkorswim account, the standard squeeze is available. Thinkorswim basically purchased that indicator from Simpler to be able to share with everybody. So you have the standard squeeze that you could set up there. The ATR trailing stop is a free indicator. And if you want a little bit more information about that, I do have a link. Let me pull it up here really quickly. But if you have an account at Simpler Trading, and you don't need to purchase anything to access these videos here. You can technically sign up for the free room and get access to this information. This is a really great spreadsheet, and I'll make sure to post this in the small account mentorship for anyone who's new. I posted in here the last week, so you guys might already have it, and if you do, you can ignore it, obviously. But in this spreadsheet, there are a lot of great educational videos. So if you want more information around different strategies, or you want more information about specific indicators that I use, you can see here all my videos are under column B. A lot of these videos I did like PowerPoint slides on to really make it as educational as possible. But as long as you're signed into the Simpler Trading website, even if it's just through access of the free room, you should be able to access these videos. And all you have to do is click on the link. That way you don't have to go searching for them on the website. It makes it a really great place to get these videos. So I talk about the individual symbols, excuse me, the individual indicators I use on here, but there's also a specific video about, let me see if I can find it. It's probably up higher. About what's on my charts and why. Oh, there it is. So right here on this video from April 3rd of 2020, there might be like one indicator that's not listed on there, but right here, what's on my charts and why. So if you really want to break down of all the different settings for each indicator I use, why I use them. That's a great video to check out. If you're like, man, I really want to know more about like the divergent bar indicator, for example, well, then you can scroll down here and get a little bit more information on why I like each individual indicator I use and a little bit more in depth around that reasoning. Yeah, Randy. Yeah, a lot of great information there. So if you haven't already bookmarked this spreadsheet, especially if you're a member at Simpler, please do so. There's a lot of good information here. For example, Neil, who does futures trading over here at Simpler, made a lot of great videos on futures. So it's not just me that you can access links to, but specifically on what's on my charts and why, or a lot of the indicators I use, I did make videos about on top of different strategies and things like that. So certainly check that out, guys. Um, that being said, though, so back over to Apple now. Certainly, we can look at an earnings trade. When is Apple's earning? What day is that? I think it's on Wednesday, the 3rd. What day is the 3rd? That's Thursday, isn't it? Yeah, it's on Thursday after market close. So I do have my free room session, which I do also host over here on Twitch and YouTube. So if y'all are able to join me or watch the recording on Wednesday, we'll go into a little bit more depth about a trade idea that we can do surrounding the earnings announcement, right? Something that we can put on prior to the announcement and then play through it. But otherwise, just in general, even if you don't wanna play through the earnings, which I get, you need to be mindful of these bigger names coming out. Amazon's another one where it's Thursday, after market close going into Friday. Now, here as well, I think Amazon actually looks pretty good. We had a recent true low, we had a squeeze, bullish signal in the compound breakout tool, momentum's reset, trying to build higher, so that looks good for the bulls. Overall, the trend is bullish. Um, but of course, right, going into earnings, we might get a little bit of a stair step higher like we saw last time, but a lot of earnings we've seen this season have also just been stuck in consolidation going into the announcement. So even if you don't plan to trade these symbols through earnings, because they're such big components of the market, keep in mind they could fluctuate things towards the end of the week. So if you have trades on the individual indexes, especially if you have something like on the Qs or NDX, just be mindful of what can happen here, right? As much as we like to play the technicals, maybe going into and through the announcement, earnings is one of those few situations where it can completely change the narrative of what's happening. Same with AMD. Yeah, AMD has earnings earlier this week. I believe they're on what, Tuesday? Yeah, Tuesday after market close tomorrow. Um, so arguably we could what time is it? I have a little bit of time, but we could look at a quick earnings trade through this. Let's see, last earnings we gapped down and then trended higher. Here we gapped up and then moved higher and consolidated. Here was a bit more of a non-event, right? We kind of stayed flat. And then let's go to a 2-year chart really quickly just to get a better view. And then so that earnings we remained flat. This one a little bit of a stair step up, but not as volatile, I'd say. This one was volatile. This was a volatile move. So there are 2 ways I typically look to trade through earnings. The first is that it's gonna be a bit more of a non-event, which AMD has had sometimes, right? Where you don't really get a move up, you don't get a move down, it's priced in, and the market, doesn't really care about the reaction, so it remains flat, which certainly given the Bollinger Bands and how flat they are is a possibility. So if that's what you're anticipating, where you think AMD is gonna have a non-event, it's not really gonna get a gap move one way or the other, the one way I would look to play it is through some sort of iron fly. Take advantage of the crush and premium on the options through the announcement if you think it's going to remain flat. So right now, I'd personally price this in probably tomorrow, just in case we do move tomorrow and we kind of change where we're at. But let's say we're basically at 113 going into the close tomorrow. So I'd look to sell the 113 strike on both the call and put side. The anticipated range is roughly 9 points. So I would go 9 points lower, which would be the 104 strike on the put side for the long, and then 9 points higher, which would bring me up to 122 on the call side. And so you can see here you're getting about a 635 credit versus a 265 risk. And the idea is if you're not anticipating there's going to be a strong move, if you think it's going to be a non event like it was, let's see, back here, for example, right, where there's not really much of a market reaction around the announcement, then what's going to happen on these strikes is they'll get crushed by the premium, right? Right now, these options are pretty expensive compared to what you would normally see for a same week expiration. And that's because of the uncertainty around the announcement, around the uncertainty of a possibility of a gap move. And so what happens is the market makers build up premium going into the announcement. And then if nothing happens, all that premium, all that theta that got built into these options disappears, right? It gets cleaned out because now we know what the market reaction was to earnings. And in turn, right, the 635 should get chopped down. So that way you could play the iron fly going into the end of the week and benefit from the crush of premium on this trade idea. So that's one way you could look to trade this. The other way, though, is if you do anticipate a bigger move, right? Let's say you think there is going to be a gap move around AMD. Well, if that's the case, normally I look to put on the compound butterfly strategy. And in this particular situation, the two butterflies I would lean towards are debit broken wing butterflies. Now, let's see if that makes sense for AMD. Roughly right? You still go within the anticipated range. So roughly 9 points from where we're trading at is at 122. And then let's just call it a 2 point width spread. That's about 95 cents. That's probably a bit more than I'd want on this. Let's see, a 4-2. That's a bit better. I might actually just go with a vertical on this, just seeing how the pricing is. So let's go with the vertical. So let's say a 4 point vertical, 5 point vertical. We'll go with no 4 point vertical. Sorry, guys. I'm pricing it out because I know what the net would be. So the idea is you play for the directional move, but you still play it within the anticipated range. But not only do you do the call side, you also do the put side because unless you have the insider scoop and really know how the market's emotional reaction is going to be around this announcement, you have no idea if it's going to be a positive or negative reaction. Just like we talked about, Netflix didn't actually have that bad of earnings, but the market reacted negatively to it and it gapped lower. So we want to play both sides. So in this case, you're looking at about a $90 cost basis on this spread. And then let's go the other direction. Once again, you stay within the anticipated range, do the same with spread. So you're paying about a 215 cost basis for this trade idea, 184 profit potential. Usually I like my risk versus reward to look a little bit better. But you guys get the idea. So basically, if we do move within the anticipated range, but we're at the very top or bottom of that anticipated range, your spread on one side or the other will be in the money, or at the very least at the money with the short strike, and you lock in a profit. If it gets a greater than anticipated move, then you'll definitely be in the money, right? It covers the risk on the other side, and you should still be net ahead. So that's the way you play for a more volatile, or that's, I should say, one of the ways that you could play for a more volatile move on AMD. It just depends what you think is going to happen, right? Do you think it's going to be more of a flat reaction and non-event? Or do you think there's the possibility of a gap move? And to keep in mind, something like this could happen where both strategies could be correct, right? The initial reaction off this move, for example, was a gap to the downside. But what happened the next day? Well, the next day we bounced back up and we were basically in the same range that we were in prior. And then by the end of the week, we were actually trading near the upside. So on something like this, if this is the kind of market reaction we have, it gaps down. If you're playing the volatile move, you take profits on the put side. On the bounce back up, right? When it stalls the next day, you could take profits on the iron fly trade idea. And then if it continued to move higher and you still have on the call side, you might be able to take a profit on the call side by the end of the week. It all just depends on what you think the market's going to happen. And the slight benefit of AMD over something like Amazon or Apple is their earnings announcements are on Tuesday, right after market close. So you have Wednesday, Thursday, and Friday going into the end of the week to still try and play out the trade idea. Whereas Amazon and Apple, you really only have the next trading day to be able to trade it, right? So you're only looking at the next bar reaction rather than, the next few bars reaction, like what's the follow through on that event. So that's an idea around AMD, but outside of that, my game plan for the week is I might look at one or two earnings trades, one earnings chart that kind of has me curious is AME. I know this isn't necessarily a big name to trade, but the reason why I'm so curious about it is notice how narrow the Bollinger Bands are getting. It's getting very tight here going into its earnings announcement, which is tomorrow before market. So this might be one we look at in the small account mentorship as a trade idea to play off of the volatility because of how narrow the range is, the squeeze getting built up to into it. I think there might be that possibility of a stronger follow through, and so we might look to do a lotto trade like that. Outside of that, though, I really want to do some scans for some symbols that have already had earnings passed or that have earnings at least a little bit further out, not this week expiration. That way we can try and look for some more swing trades to consider playing. Um, but with, the bigger names having earnings later in the week, you might wanna do some shorter term scalp trades going into those announcement, maybe be a little bit lighter on capital if you don't plan to play Apple and Amazon earnings themselves, wait to see how the market reacts to that, wait to see how the market itself reacts, And then once we get through those announcements, go back into, finding those swing setups and everything like that. So that's kind of my game plan for the week, guys. Thank you so much for joining me. As always, may the trade be with you, my fellow Jedis. And for those of you on YouTube and Twitch, I look forward to talking to y'all again on Wednesday. Otherwise, for those in the small account mentorship, we'll talk later today. Bye, guys.